I think that there is a little bit of groping in the dark when it comes to forecasting oil prices. And certainly just on purely statistical grounds, we have not had much luck in forecasting turning points or directional indicators about oil prices. I think that we have to look at fundamental factors, and by that I mean the nature of the market, changes in technology, trends in costs of finding and producing the oil. Also, government policies will be affecting the price of oil. Developments in related fuels would be affecting the price of oil. So if you take all of those fundamental factors into account, I think then we do see some directional indicators. Will prices be rising or falling in the long run? The short run is quite a different story because it's determined by so many unpredictable shocks to supply, to demand, the financial system, all of these factors that tend to push prices around. And of course then there's OPEC and the geopolitics that go into the world oil market, and these are very difficult to predict. And all of these uncertainties are magnified when it comes to predicting the price. Even a small physical shock, a disruption to the supply of oil, is magnified very much by the inelastic demand, by the rigidity of demand and supply. So a very small physical shock can create quite a large price change, either up or down. And of course we've seen a lot of that. It's one thing then to predict the physical disruptions, but then to scale them to the market effect on prices is another very difficult aspect of forecasting oil prices. Oh, I very much agree. I think the first two factors, the growth of demand and also the role of the developing economies, are really one and the same factor. It's very important what will be the future of economic growth in China and the other developing economies. That'll have a big impact on pressuring prices upward or maybe releasing some of the pressure. And currently the indications from China are that there may not be the same prospects for continued growth. So that's going to be very important for sure. I think another factor which hasn't really been listed in the premise of the question is really government policies regarding carbon. What will be the future restrictions, taxes, other trading of emissions that could potentially limit the growth of hydrocarbon fuels and increase the price as well. It seems very uncertain right now whether we're headed to more stringent carbon trading restrictions or taxes. It's uncertain in the United States for sure, and I think even in Europe now there's greater question about the affordability of some of the market intervention. So that'll be determined only by watching policy form over the next 5 years to 10 years, I think. But we can't leave that out as an important factor. And the point about the U.S. tight oil supplies, shale oil, horizontal drilling, fracking, all of these have contributed to an astounding increase in liquid production in the United States. And I think those are so powerful in expanding the resource base that it's going to spread around the world. It will not be just the U.S. unconventional oil. 5 and 10 years from now, we'll see this happening in South America. We'll see this happening in Asia. To some extent, we'll see this happening in Europe and England as well. So I think it'll be a major expansion of oil supplies. Of course, it has the potential to limit increases in oil prices or perhaps even cause reductions in prices going forward. Well, I agree that it's often said that it does. I don't exactly agree with the hypothesis, though. And I think there are two ways of stating the impact of speculation or financial traders. And the one that I do not agree with is the simple view that the financial trading, the purchases, creates buying pressure, which forces the price of oil up. The way financial trading works is that if I'm a speculator and I'd like to make some profit, I'll buy a contract in the futures market, maybe for delivery of oil in 1 month or 2 months or 3 months. But before delivery takes place, I'll sell the contract back. The same contract I buy, I sell. And that's called financial settlement. I never take delivery of oil. If I'm a hedge fund, that's the last thing I want is a tank full of oil delivered to my Wall Street headquarters. So I sell the contract back. But that means that the initial buying pressure is offset by equal selling pressure. Each and every contract that's purchased is sold back by the speculators. And so buying pressure equals selling pressure, to me equals no pressure. I don't see the logical basis for that version of the hedge funds pushing the price of oil up. The alternative channel, I think, is a very real channel, and that would be to say that the trading activity of the speculators, or the banks, the financial institutions, that trading activity affects the expectations of commercial traders, producers of oil, refiners of oil, the airlines, transportation industries that are using the fuels. So it could be a type of a contagious effect if the speculator's view is then adopted by commercial traders that actually do take delivery of oil, that do build inventories or draw them down. That would be a channel that at least passes the logical test of economic thought. But having looked at the research and having done some research myself over the 2008 price spike, I really don't see evidence that that happened, that the speculation was responsible for the price spike by creating or transmitting these expectations to commercial traders. So very little connection historically. Going forward, it's a possibility that financial trading will affect prices in some fashion, but I think not through the simple-minded connection that hedge funds force prices up by their own volition.